Hey everybody, thanks so much for joining. We see a bunch of participants kind of coming online. We're going to get started in just a couple minutes. We just wanted to say thanks for joining us, and we're waiting for everyone to come on. We're also live on Facebook, so if someone doesn't have the link or didn't register, they can always kind of hop on our Ben Property Source page if they wanted to. And I think we've got a couple of listeners who are just calling directly into, so we're just waiting for everyone to join. But I think we're getting close here.
And Meg just put one reminder in there that if you have any questions, please put those in the Q&A here in Zoom as opposed to the chat. And that'll be a little easier for us to monitor so we can make sure to get to those. So it looks like, yeah, we're starting this at 4. I think a lot of people are we're starting to see everyone, participants are jumping. Yeah, here everybody comes in. So what I don't want to do is get it started too fast and have a lot of people miss just as everybody's sitting around that virtual table. So we're going to probably give it just 1 or 2 minutes more. But I appreciate everybody. We have quite a few people here already today, and then we're going to look to share this with a lot of different forums in the coming weeks. So hopefully we can distribute it as far as we can. One of the questions actually that just popped up while we have a minute or two to wait to everybody to get on, we saw a question pop up in the chat here that said, I have a question. Based on the prior market downturns in Central Oregon, what have you been seeing for the impact on building prices for custom homes? They purchased land in Bend. They've been holding off on building since builder prices have been unchecked, seemingly unchecked for several years. Might 2021 be a good year to negotiate and build? So good question. I actually just had a conversation with one of the top builders here in town yesterday about forecasting. Builder margins, interestingly enough, have always remained fairly standard throughout the ebbs and flows, and usually those costs, the cost increases and decreases usually have to do with material costs and the subcontractor base, and the prices are adjusted accordingly. This builder felt that if we do have a slowdown, the supply channels have also been, shut down as well. Supply will slow down, so they don't see big price reductions coming in supply. They think that they're going to have more ability to renegotiate with subcontractors when they run out of their current book of contracts in the next 2 to 3 months. So they're thinking that, fall 2020 and 2021, they're expecting lower housing cost, going forward. So 2021 might be a really good year to build a house. If not, even end of this year, I think starting that process might be good. I think 2021 is actually going to turn out to be fairly busy, but yeah, I think it's as good a time as it has been the last couple of years to start that process. So Aaron, do you want to get us going here today? It looks like we've got quite a few attendees, and I don't want to make them wait any longer.
Yeah, no, I think that's perfect. So welcome everybody. We're really excited to have you. So the topic of this is navigating the housing market in uncertain times. And so we just really felt like a lot of our clients were clients, friends, colleagues, everyone is just kind of looking for some direction and some insight as to what we're seeing in this kind of microcosm, this little market of Bend, and how it plays out in kind of the bigger picture as well. So we're excited to have you here today. We're going to try to keep the content, just a couple housekeeping items. We're going to try to keep the content to 45 minutes and then leave plenty of time for question and answer. But please feel free to pose your questions in the Q&A section here. In the chat section, maybe that's kind of where you share information with everyone listening, but the Q&A would be specifically for us, and we're going to go through that and monitor that. We're also going to monitor the questions on Facebook simultaneously, so we'll try to make sure that everybody gets a chance to ask what's on their mind. There's going to be a couple of polls that are interactive, and we love your input and insight throughout. And so thanks so much in advance for doing that. So I wanted to introduce to you some of the panelists. There's just a couple of us from the LAD group here today, and then also Clint Edwards from High Lakes Lending. Brian, do you want to go to the next couple of slides? Awesome. Okay, so the people that will be speaking here today from the LAD group, specifically, we have Brian Ladd, principal broker, and then a 20-year veteran of both, residential broker, developer, builder, investor, also on the Forbes Council, and of course, the #1 broker in all of Sotheby's in the state of Oregon for a couple of years running now. And then myself, I'm a broker here, and I specifically focus on our listings. Alice Fairburn from our team as well, and she's both an ABR and a pricing strategy advisor, and she handles a lot of our buyers and then helps manage the team from a buyer's perspective. So I think she's got a lot to share today. And then Clint Edwards is the president of High Lakes Lending, who is also a 20-year veteran, both broker and banker. So it's wonderful to have you all. So we're going to go through a couple things. Within that 45 minutes, we're going to focus on the historical perspective and kind of put that in context of what we're seeing today. We're also going to focus specifically on how the financial markets are affecting what we're experiencing. And then we're going to dive deep into the stuff you really want to get to, the meat of it, which is the current conditions for both sellers and buyers. And then we'll leave plenty of time for Q&A.
So I think I'll jump in here, and I wanted to start it off with this comment by Jack Welch. Some of you may know he's a titan in the auto industry and a master of business. And there's a famous quote by him that says, "Face reality for what it is, not as it was or you wish it to be." And I hope that we can start this webinar here with you guys, with everybody here, understanding that we're trying to come from an unbiased, genuine state of mind. We want to be of service to everybody, to our clients, to the public, and not have a cognitive or industry bias and take on what's happening, because telling everybody what we wish it to be doesn't help anybody. And I hopefully that our listeners can also keep that in mind when we may put forth fairly optimistic information in certain parts of the industry when we're dealing with the sky is falling if we're watching the nightly news. So hopefully we can maintain an unbiased perspective and open to new ideas. You know, the whole scientific method is based on putting out a hypothesis, challenging yourself, and then be willing to change that as you go forward, or you'll never really become, you know, a true scientist. And I think that I'm trying to maintain a similar perspective when I'm looking at the overall economy and what we're facing here. It's fairly unprecedented, and it's an interesting challenge trying to understand where we're going, but we think we have a pretty good indication of where we are. So I'm going to just take about 15 seconds here. I want to go over some basic assumptions. So let's start with the understanding that health is the most important factor during this time. Nothing supersedes this. Our housing industry, nothing else is more important than the health of our friends and family. And we're going to continue to work with the utmost caution and care for our clients. And we have all kinds of interesting protocol that we put into place, and we've learned how to operate in this world safely, and we encourage everyone else to do so. As well, the data that we're going to go over here in just a minute is subject to change. A lot of the metrics that we're changing or watching are changing on a weekly, daily, hourly basis. And so if the pandemic trends change, or we go into a prolonged economic shutdown or unemployment for long periods of time, obviously we're going to have to adjust with that, but we're going to base our advice and interpretation of the data on how we see it today. And we just need to all keep that in mind that it's subject to change. We don't have a crystal ball. We're certainly not COVID experts. And the other thing I just kind of want to end this with is it would be easy to hide from talking about this. There's a lot of agents that are just not talking about what's going on because they're not sure what's going on, and they're fearful of giving bad advice. And we too are not trying to tell our clients to buy or sell. We feel we're going to support their decision in wherever they are at in their life, and we simply want to arm them with the best information that's at our hands. We do not have an ulterior motive. We're not trying to convince anybody. You know, the LAD group, we're long past needing to have a client buy or sell right away. We want to be your advisors for life, and hopefully you guys can understand that we're coming from a position of help, and hopefully we can find some commonalities in what we go through today and create a path forward. So we're not going to be hysterical about this data, and we think we've got some interesting subjects today. So let's start with the overall economy. So before we get to housing, I want to talk about the correlation between the overall economy and housing, because they correlate, but they are not, they're not always perfectly in tandem. So let's talk about the overall economy. When we're trying to understand what's going on, I'm trying to go to minds that are smarter than mine, where people have a lot more data at their fingertips. So this is an interesting slide that we put together from the top 3 investment banks. This is Goldman Sachs, this is JP Morgan, and Morgan Stanley. And this is their interpretation of what's going to happen to GDP growth here in 2020. And what we're seeing is a commonality in their projections, which is reassuring. You know, if they were all divergent, I think we would have give more pause to this. They're all in agreement that we are going to have a sharp, swift contraction in the economy here in Q2. It's going to be a wild ride. I think we all need to buckle our seatbelts, keep our hands in the roller coaster, and be prepared for what we're about to go through. Unemployment is at unprecedented levels, and it's going to be a sharp contraction of the economy. And while the recovery timelines differ, some people are saying Q3 2020 to some are saying Q4 or even Q1 of 2021, they're all in agreement that this is looking for a sharp snapback from the economy. And this is more akin to a shock or a market disruption or a natural disaster. You know, let's think 9/11 or, you know, Hurricane Katrina on a micro scale, and not from built up excesses in the market that take years to play out. You know, in the Great Depression that we went through in 2007, well, we started in 7, 8, 9, those were built up excesses, and it took a long time for the economy to work through those. The way we're looking at the economy right now, or the way that, you know, these investment banks are, and the way I'm interpreting it, is that this is a shock to the system, and once we kind of wade through, it's going to be a fairly quick snap back. And this also played out with other market shocks like the 1918 pandemic and 9/11. And, you know, I never thought I would have to go back to find a common thread to 1918, but we had to do some of that here in understanding the data. So let's talk about unemployment, because unemployment does affect housing. What you see before you is the weekly jobless claims, excuse me, for the state of Oregon, averaging anywhere from about 5,000 to 10,000 claims per week with annual spikes. If you look at the far right side of this chart, it's awfully interesting. It's almost off the chart. And where we went from, you know, 4,000 claims a week to over 40,000 in 1 week, this is something that we've never seen before. And we have to understand that this is going to impact both the economy and housing. And we can talk about, you know, just in a little bit more detail. This slide here, this is another Goldman Sachs projection of where we're going to see unemployment rates go. This was from about a week ago, and there was actually some new data coming out this morning by Goldman where they're actually revising this upward. They're projecting average unemployment for 2020, or by the end of 2020, to be 15%. This is something we've never seen before. And actually the data I was looking at this morning said even a little bit higher. They're revising their projections upwards to 20% for this year. But the jobs that are being impacted at this point are largely, it's starting to spread. At the very beginning, we're in the service and hospitality industries, which also snap back relatively quickly. You know, once a hotel, once a restaurant, once those type of businesses open up, that staff that onboards quite quickly. The variable on this that we need to talk about is if this pandemic requires a longer than expected shutdown, jobs that are slower to recover are going to become more affected. These are professional services where a company can't hire 50 people back in 1 week. So we need to keep that in mind and watch how long our economy is shut down. I don't have an agenda there of timelines of when it should open, but we just need to keep that in mind that if this goes on through the summer into the fall, that's going to have a deeper impact on the economy and housing.
Yeah, Brian, so just a quick question on that. So yeah. A lot of people are asking, and I know Steve chimed in as well, but with this kind of spike in unemployment, really the question is how much pressure is that going to put on the housing market? And can you speak to that a little bit? It's on people's minds.
Absolutely, because when people don't have jobs, they can't afford a mortgage. So the linkage is quite clear, right? There's two main things of unemployment, and it's actually good timing because this slide talks about it. There's the depth of the decline, and there's the length of the decline. And so if we look at the depth, that 15-20% that we're going to see, so this graph that I just pulled up, if you look on the far right side of it and go to the current crisis, whether 2020 is 15 or 20%, it's horrible. But what they're projecting is by 2021, we're back to 6 to 8%. Back to 2022, we're back down to 5%, which is below historical averages. So if we have a depth, it's going to hurt. A lot of people are going to be out of jobs. It's going to disrupt the housing market. But generally, the duration is what kills housing. And so if you look back, like let's go all the way back to the Great Depression. There were 4 years over 20%, and there were several years in the double digits. And it's that protracted unemployment of 2, 3, 4, 5 years that really just takes the wind out of the sails of housing and stops that machine that's so hard to start up again. And if you look back at the Great Recession, 2009, 10, and 11 were all above 8%. And so the way we're looking at, potentially we could only have 1 year at that type of rates and with a quick snapback. So a V-shaped recovery would not be bad for housing demand in the long run or even the midterm. You know, it's how that is protracted out over time. The other thing I want to get to is everyone, you know, myself included, equate recession to housing crisis. And I do want to dive a little bit into the details. I'm not saying that housing is not going to be challenged this year, but I'm insistent that recession is not directly correlated to a housing crisis. So if we look at the last 5 recessions, it's an interesting fact that in 3 of those recessions, housing prices went up. One went down slightly, it was 2%. That was the Gulf War, 1990, 1991. And then, of course, the one that's so fresh in our minds is the one that we've all experienced within the last 10, 12 years here, was in 2008. We did see a housing correction nationwide of 20%. Here in Central Oregon, it was even greater. So I think we just need to keep that in mind, that there's not a direct correlation between recessions and housing. So housing kind of beats to its own drum a little bit, right? There's the microeconomy of the home buyer and their personal debt situation, and then there's the overall economy, there's the stock market and the GDP growth and whatnot. I don't want to get too wonky on this graph. I have a tendency to kind of get deep into the details. But what this shows is if you look kind of just left of center where we have that gray line, that's the recession from 2008 through 2009. Now to the left of that, that blue line that kind of goes up, that's the amount of homes or homeowners, excuse me, that are in debt collection. Means they're not doing well, debt collection's coming after them. And what you see is that debt collection actually spiked back in 2004, 3 or 4 years before the recession. So homeowners were already on thin ice. They were overextended. The foreclosures, bankruptcies, all that were actually increasing even during the boom. If you go to today, we're at about 60% of the people that were in foreclosure at that time. We have much lower levels of, debt collection, lower levels of debt, higher equity in their house. So the homeowners themselves in general are on much more solid footing to go into insecure times than we were in the early 2000s. So does that, yeah, okay. This goes into it a little bit more. Let's talk about personal debt composition. So this is the health of the homeowner, right? What was really surprising is that we have over 50% equity in our houses at this point going into this correction. And over a third of the homeowners actually own these homes free and clear. So what this tells me is that there's going to be a lot more of insurance against some of these, the challenges that we're going to go over the next year or so than people that were doing 100% loans, stated income loans, that they were doing in the early 2000s. Clint, here, could you chime in on this? Because the part on the right here, I think would be right in your wheelhouse. We're talking about home equity cashed out, and the data that I came up with was that in the 3 years leading up to the Great Recession in the early 2000s, U.S. homeowners took almost $1 trillion to refinance out of their homes, but when we look at the last 3 years, it's about a fourth of that. And so it seems like me that people have a lot less debt on their house, a lot more equity, and they're not using it as the ATM like they were in the early 2000s.
Yeah, Brian. And by the way, thank you for having me on this. I appreciate it. And thanks for everybody for joining us. You're right. There was a lot of speculative lending going on back leading up to the 2008 time frame, and I think both the industry and people tend to have learned a lesson during that time period. And I think leading up to now, I think that people have been a lot more conservative in using their home as, as that, like you mentioned, an ATM machine. I think nationally, I think the average is, or the average is 53%. LTV is average nationally for folks with their equity position in their home. So it is, we are a lot more conservatively placed at this time with the lending that's going on.
Oh, good deal.
I would agree. And I would just say anecdotally, a lot of the sellers that we're working with have a lot more equity in their homes these days. And I think that's one of the reasons that everyone is a little more concerned, is because they have a lot of equity and they haven't cashed it out. And so they're wondering if if price changes are coming and how that's going to affect them in the long run, because they've been, counting that as, as a financial security for them.
Yeah, okay. So let's go and operate under the assumption that the homeowners generally have less debt and they're in a better situation financially on a personal level. Let's talk about something else that has a bigger impact on housing. This can be measured as inventory. Inventory is generally measured in months. So in months being how many months it would take to sell all the homes that are on the market if no new homes are brought on. So let's go back to 2007. Let's say December 2007. That was the official declaration of the last recession that we went through. At that point, we had 13.9 months of homes on the market. If anyone here had a house on the market during those times, you know exactly what I'm talking about. It felt like there were thousands of homes. You'd look down the street and there would be house after house for sale, and the buyer pool was very thin. And so inventory has a direct impact. When inventory levels get that high, it's a snowball effect. Eventually somebody needs to sell, they're going to start dropping their price, someone else needs to get ahead of them, and it becomes a downward trend in pricing. And so when you're dealing with a year plus inventory, prices generally go down. 6 months is kind of the general rule of thumb that we have in our industry for a balanced market between kind of buying trends and selling trends. So let's fast forward that to today. So where we stand today is 2.9 months of inventory. So we have roughly 1/5 the amount of inventory that we have going into the next recession, or than we had in the last recession. So I'm not saying that inventory can't climb. Sales slow down, obviously, even if no new homes are brought on, if sales slow down, that inventory will go up. It's based on absorption rates. But we're in a much healthier position. Those inventory levels started to climb back in 2006. Here we are in 2020, spring of 2020, and we still only have 3 months of inventory in the market. So what was interesting about the last recession is that we went in with a surplus of homes. I'm not sure if anyone remembers or was here in Bend during that time. They were pulling almost 4,000 building permits a year. They were putting houses out of the ground as fast as they could. There were investors buying homes with negative, or as investments, with a 10% vacancy rate in the rental market. They couldn't even put people in, and even when they put people in them, they had negative cash flow, and they were okay with it because they were all speculating that the market would continue to go up. The way we stand now is we're 1 to 2% vacancy on on rental market. We have very low inventory. Housing is very challenged in the sense that there's a lack of supply. The urban growth boundary is a very slow thing to move. Took over a decade to happen last time. We don't have developable lots for the builders, and the ones that are very expensive, and the builders aren't jumping on them. So we're at a much more sustainable thing. And during the last recession, we couldn't build our way out of it. And historically, some of the recessions have kind of been saved by housing, because once the housing machine gets going and people start building houses, the job multiplier effect from each one of those houses is immense. And when you have too many homes sitting on the market in a recession like we did in 2008, 2009, 2010, that couldn't rev up and get the economy going. So the National Association of Home Builders, Fannie Mae, most people are in agreement at this point that we're actually going to be the bright star of this recession because we have so few homes, there's a shortage, and the construction is actually going to help drive us out of the recession. So we're going to be the shining star of the recession rather than the laggard that caused it with an oversupply.
Yeah, and I know Alice is going to talk about it in just a minute, but I think an additional item is just the migration rate into Bend. We don't, expect a change in kind of people wanting to make Bend home, and so we can't build as fast as people can come. I think is still going to be the case. Do you agree?
I do, but I've always said that when San Francisco gets a cold, Bend gets sick. So migration trends can stop, obviously. If the housing market and the economy slows down there, they're not going to sell their house and move here. But the long-term trends, absolutely. The reason that we're a rising star in the West Coast is not going to change because of COVID. And the pressures that we have for the demands that we have for the limited supply we have is going to continue to put pressure on our limited housing stock. And this is, I'm about to pass this over to Aaron, and I don't want to get too wonky here. I have I'm a closet economist or wannabe. There's a really good book that just came out by Robert Schiller. He's a titan of economics and in our housing industry. And this new book that he came out with was called Narrative Economics, where how stories go viral and drive major economic events. And even Ben Bernanke said that, hey, in the absence of panic, the declines that we had in unemployment, consumption, and output of the last recession would have been significantly less severe. So I guess I want to go in kind of, before I pass on to Aaron, to talk about how do sellers react in this market. I think how the market reacts is largely in the narrative that the industry has on how we react to this. Because fundamentally, housing is in a pretty solid state. It's gonna, should be able to weather this. But if everyone thinks it's bad, it will be so. So I think, we have to remind ourselves that we have to not get caught up in the hysteria and the hyperbole of what's going on, and stick to the facts. And hopefully, as a bigger economy, we can all stay on that path.
Yeah,
so Aaron,
absolutely.
you want to, so Erin does a lot of our sellers. She helps, list a lot of our properties, and she's going to, position and talk about, as a seller, how she's looking at this market.
Yeah, and I mean, I just wanted to first off kind of just put it out there, the elephant in the room, and that is that typically real estate cycles are 7 years long, and we are 9+ years into that, because December of 10 was the lowest of the low in the last recession. So why are we past the 7 years? Why are we still, performing well up until, kind of mid-March? And then why did we have such a strong Q1 that we experienced? And I just wanted to kind of speak to that a couple of slides. And then also we're going to get into kind of the logistics and the nitty gritty of how we coach our sellers into how to handle this specifically. But so if you see here on the left is sold, on the right is pending. And so of course, there's a leading and a lagging indicator here, but for the sold, you can see there's kind of a nice uptick. And if there were a graph, and there is one, I think, upcoming, that shows kind of for the last 10 years, you'll see that it's fairly cyclical, and but a strong, solid uptick movement upward. And then also for pending sales, and you can see, a bit of a downturn there, but pending sales have been, kind of climbing upward continually. Next slide. Yeah. So Brian mentioned earlier that we're at 2.9, let's call it 3 months worth of inventory. And I just wanted to put into context exactly what that means for our sellers specifically. So 3 months of inventory is still absolutely a seller's market. In fact, it could even double and still remain, a seller's market, not even get quite to neutral before it becomes a buyer's market, like we saw in 8, 9, 10, and even early 11 here. That would be 7+ months of inventory. And while, that is absolutely possible, we're looking also at the leading indicators that have to do with building permits, like Brian mentioned, and we're not seeing builders pulling permits the way they were. Now, this is the time of year where builders would pull permits, and there's kind of a weather factor here. So builders don't want to pour foundations when the weather is cold and it will freeze. So they don't usually pour foundations between kind of October and right about now. And they don't want to pull the permit until they're about ready to pour their foundation. So when we watch those numbers, we can kind of have an idea of how much more inventory we might expect to come on. And we're just not seeing the numbers, in droves the way we would expect. So I want to put into context also, if you want to go back one minute, I don't think I kind of explained fully, but low inventory and like the 3% inventory, the seller's market that we see here, means fewer competing homes. So buyers have only 5 instead of 15 homes to look at within the kind of the parameters that they're searching. And in this context, that kind of provides a resistance to price drops, because of course you can keep pricing high if the buyers don't have a lot of other options, and that's kind of what they have to choose. So I think if we go to the next slide, I think that's relevant here. And I wanted to go into actual year-to-date closings and speak to that a little bit. Now keep in mind, this is all pre-COVID, because closings of course would have had to happen 60 days. I mean, Clint can speak to it, but we're 45 days or so between the appraisal and the time that it would take to close a home. So these went into contract pre-COVID, if you will. But if you look at 2018, 841 closings in the month of March. And then if you look at 2019, that was down a little bit. And we absolutely felt that. There was a change in kind of the body heat, if you will. In 2019, that was down by 22%, just specifically for March. Keep in mind, though, that we also had a very strange weather pattern at the end of February and then beginning of March, and there was that crazy snowstorm. So closings may have been pushed off, between the 2 months. And then, of course, in 2020, we were up. So consider that schools were closed, things were closed. We went into full quarantine kind of in mid-March. The beginning of March was so robust that we're still at 14% for the entire month. So I think it's relevant to note there. Okay, so I think this is interesting, and I wanted to share it. And we all know, we kind of have noted that there's a steady climb of the median home value in Bend. And sometimes we're like blown away, holy moly, in the 80s, I grew up here. So in the 80s, it was 45,000, and now it's 450,000 for a house. But 2018 was 395, and then we've gone up 6% and then up 7% from that. So right now, if we're just kind of putting things in context, we're calling it 450 for the median home value in Bend specifically. Now keep in mind that we have also seen a growing trend of reduction in sales prices. There were 55 price reductions in the last couple of weeks. And so we're definitely recognizing that price reductions are coming. And so we're not necessarily going off of the previous numbers. We're taking into account that there will be a change for sure. Okay, I'll let this one kind of sink in for a minute, because there's a lot to look at here. But this is pending sales for 10 years. Of course, there's the cyclical nature that you'd expect, partly because of buying patterns in schools and things like that, but also because of building patterns, and new construction, of course, can only close, 6, 8, 9 months after it starts, or longer, depending. If you see here, though, the March pending units for 2020 were 461, and that includes, now that's pendings, not closings. So that means that people, who actually went into contract, into escrow. And so if you notice, there were about 2 months there where things were a lot slower, but people seem to have still been going, moving. If you put that in context of what the 2019 pendings were, it's only a 5% delta. It's only 5% off. So it was either a very, very strong Q1 that we can't quite explain, or buyers are still buying and sellers are still selling. And that's really what we've been experiencing in this market.
Yeah, Erin, have you seen that change at all in the last 2-3 weeks since that, that data stopped March 31st?
We've absolutely seen less activity, and we're about to kind of dive into that. We've seen less traffic, fewer showings, and all of those metrics that you would expect to be down are down. What is surprising me is the strength and resilience of those buyers and sellers who actually are in the marketplace for a reason and have motivation to do it. Gloves and everything, they are ready to go and they're ready to still see things. And I'm surprised by the activity that's still continuing, because I, thought we'd all kind of kick up our heels for a month or two, and we're not. So I think this is one thing that's really interesting, because we don't want to pretend that this is all rosy picture. This is the showing time statistics. So this is specific all the way through to, April 13th. So, really real-time data. And this shows that across North America, the showings and the showing calendar, especially using this platform, are down by 47% weekly in the weekly average for 2020. So we absolutely are recognizing there are fewer showings in general. And I would note a little caveat to that, that we're noticing here in this market, is that a vacant home is much more apt to be shown, probably twice as likely to be shown.
Yeah, so Erin, let's dive into that a little bit. So if buying activity is only down 5%, the pendings are only down 5%, but showing is down 50%. What's happening in that delta? Are people looking at less homes? Are only the motivated buyers out actually, out in the market? What's happening there?
Well, there's absolutely fewer homes on the market, so they just have less to choose from in general. So with that 3% inventory, of course, you can imagine that within their search parameters, X number of bedrooms, this large of a yard, has to be this school, district, et cetera, et cetera. There's only 5 to look at, perhaps. And I think what they are doing is narrowing them down before they actually physically kind of go inside. The other thing we're doing a lot of virtual showings and virtual tours, and people are leveraging, kind of the videos that we brokers have been usually providing a lot more often. There's another factor that I'll take into account, though, and that is that a lot of the buyers are from out of market. We're definitely have a fair number of that. Probably half of what I do, in general with buyers is out of market, and sometimes even sight unseen. They'll make offers. We are noticing that they are not physically able to get up here, so we're handling a lot of that for them for those showings. Absolutely. So that would not count as a showing on the showing time thing, because it's a broker who's just kind of going in to preview it, if you will. Yeah.
Yeah, and we also pulled up some data here from our website showing the increase in that. Would you go into that just a little bit?
Yeah, I think this is really powerful, really interesting, because it mimics the kind of buyer behavior we would expect typically, and that we usually see, in past, during Christmas week, or if there's a bowl game on or something, we absolutely recognize this. So we look deeply into this, and we see that, this is kind of April 1st through April 12th, 2019 versus, this 2020 kind of period that we're seeing. And we're recognizing that users, sessions are up, and then bounce rate, of course, is down. So people aren't bouncing onto the website and then coming off and not looking in depth. So our users are up by 1,000. And I think that's really interesting. People are absolutely still looking at homes. They're just doing it online. They can't physically always be here.
Yeah, so that 1,000, it looks like if we're at 3,500 people looking at our website monthly at 2,500, that's a 40%. So while we may be down 40% in physical showings, it seems like that online traffic, that's exactly where it went. So
yeah, absolutely. And the exposure that we're getting for our sellers is really incredible. I want to be mindful of time, so we're going to crank through the next couple so we can give Alice and Clint plenty of time to look. But I want to go over this really quickly, and that is we're recognizing kind of a niche within this market that we think is going to be greatly affected, that maybe a lot of people are overlooking, and that is our investors. A fair amount of what we do is supporting our investors either in short-term rentals or in kind of longer-term assets. And so we see that short-term rentals are completely stopped. So for, Airbnb is a good example here. You see the revenue, their revenue equates to their bookings. So you can imagine if all the bookings have turned off, of course, the revenue is as well. So even the Americas, Asia, Europe, all across everything's completely shut down. And we expect that it's going to potentially bring some additional homes on the market, specifically because investors were looking toward those bookings to kind of offset the hard costs that have to do with owning that home as a vacation rental. And so we expect also kind of as a secondary tier to this, a really interesting phenomenon, and that is that, of course, there's a no eviction policy put in place for the COVID, kind of the quarantine time period for sure. But there's also recent landlord tenant laws, and the compression of both of those together, I think, is going to create a scenario in which a lot of our investors, when their tenants finally do move out, and so they're able to then make a change, they would go ahead and sell their investment product and look toward something that's a little more investor friendly, like maybe a Boise comes to mind, things like that. So we're expecting that there might be additional inventory coming on the market, specifically investors type product, which is a certain product type, a certain price point, typically, usually pretty low maintenance, et cetera, et cetera. And so we want to take into account that while inventory is very low, there might be a range or a specific focus in there where there might be more inventory coming on market. No, I don't think that'll flood the market for two reasons. Number one, those short-term rentals, everyone could come and want to suddenly, go for vacations, and they could be booked up all the way through the fall, and that's potential and probably plausible. And then the other thing is that the landlords actually have to move out in order for those, or the tenants have to move out for the landlords to sell them. So it's going to be more of a trickle and less of a deluge, if you will. So. Okay, so 3 things, and then we'll get into some questions from sellers' perspectives. But I'm continually asked, is this a good time or a bad time to sell my home? And my answer is yes, because the answer, really depends on you specifically. So we get into kind of scenarios rather than specific tips for you all. So this first scenario is if you need to sell now, or if you're inclined to sell now, then let's go ahead and do it. It's really good visibility. You're going to get some showings. You're going to have very little competing inventory. Of course, there's the parameters or the things that you'd have in mind, which are health concerns, maybe social responsibility, and then we're not able to get the momentum that we would really typically garner through our different protocols, including our mega open house that we have the first weekend when we go live with the listing, et cetera, et cetera. So I think it's something to take into account, that you're not going to have, you know, all the momentum that really drives offers and potentially multiple offers. Brian, do you want to talk a little bit about pricing and the right pricing, you know, aspect of this?
Yeah, so what we're seeing is that sellers are successful. We, you know, Aaron, you and I just went over the statistics. On our sales that we've done for our sellers in the last month, we're averaging what, 98 and a half, something like that % of sale price to list price, or yeah, sale price to list price. So we're still maintaining price integrity for our sellers. That's with the caveat that homes are priced correctly. So in the situation that we're in, I think sellers, you know, sellers have been holding the keys of the market for so many years. I think they need to keep in mind that they have to be priced right, and they can no longer extrapolate their price kind of beyond the recent sale, saying, oh, it'll just take one buyer. You know, we'll get plenty of showings. Eventually that right buyer will come along, and then the market corrects that overpricing. So, you know, if you are wanting to sell now, I think you need to look yourself in the mirror and give it a real unbiased, you know, analysis of what your home's worth and what it can sell in that market. And that's definitely a strategy that you need to put together with your seller, because you can't afford to be overpriced in this market. If you're right priced, you're presented correctly, especially if it's a vacant home, you stand a very good chance of selling in this market.
Yeah, I think that's a great point. And then the other thing I would say, you know, specifically having to do with pricing, is that a lot of our home buyers who are coming into this market are maybe having challenges selling their current home from the other market they're moving from. And right pricing in all markets is going to be really relevant, because if you want to make that move, it's the only way to do it efficiently and quickly.
Yep.
Okay, so the other kind of the second option is, of course, the prepare now. And I think this is one of the most common, especially for the people that we're speaking with, because obviously if we're connecting with them and doing kind of strategies with them, it's because they have it on their mind that they'd like to sell at some point, probably, you know, plausibly in 2020 was their goal. So the way that prepare now works is that you get your home ready. So you do all the honeydews and you paint everything and you plant the flowers and you get it all ready. And we prepare the marketing. We do, you know, all the videos and the photos, and it doesn't mean we're in your house, but we'll take the utmost caution. I just want to make sure we've mentioned that enough times. But and then we, you know, we work through kind of our marketing strategy and all the details of that. And then we all sit together and we kind of hand in hand decide to watch and wait, and we be nimble. And when we feel that surge of momentum, we start to make our move and we go live with your listing. And it would be kind of in tandem. If we wait for the metrics to show us the market has already moved, it will be too late, and there will be potentially more inventory on the market, and you've missed that window of time. So that's why the prepare now is so effective. The drawbacks to that, of course, are the timing fluidity. We just don't know, and neither do you. And so you've got to kind of be willing to be on hold for a minute and just wait and see. There's also economic factors. We can't promise that the prices will be higher when you do come on. We'll do everything we can to get your house right price, and we'll do everything we can to get it sold, but we're just not sure, and we need to also kind of be a team on that. There's also potentially the situation where there could be an inventory increase, for sure. And of course that, reduces the pressure, reduces kind of, the visibility and the exposure that your home will get, because there's more, options for the buyers in general. So then the third thing.
Aaron, before we go off that's a really good point. I don't want us to step past that too quickly. There's a real potential that we're going to see a lot of inventory come on the market at the end of this stay in place mandate by the state. So there's a lot of people that simply don't want to deal. They don't want people in their house, and we totally understand that, and it's socially responsible to do so. That said, we're going to have, the way we have a whole protocol in place approved by the state and how we show houses. And when we do it, sellers aren't at the house, all the doors and windows are open, lights are on, and it's very, it's a very tedious process. But I do think there's going to be a flood of properties that will be coming on once kind of the world opens up again. So if you're a strategic seller at this point, it's kind of an interesting time. Even though buying activity is down, generally spring is the flood of inventory. I think the flood of inventory is going to happen more in kind of end of Q3, even into Q4 of this year. It's going to be an interesting time to sell a home. and the whole seasonality is going to be upended. So, you know, I think that inventory, that normal growth that we usually see March, April, May, you know, kind of a lot of factors there, but I think could be more of kind of an August, September, October of this year.
Yeah, if you want to go back to that slide for scenario 2, we've got somebody asking us to pop back to that one for a second. Awesome. Okay, so we'll just make sure Sherry gets a good look at that as she asked, and then we'll go over to scenario 3.
Great, and we've got a copy of these slides, and if anyone wants a copy, just put a note in the chat or send us a note. We'll be happy to share this with you.
Yeah, absolutely. Yeah. Okay. So then the third, you know, opportunity kind of approach would be to hold for now. And we recognize that this is a really smart strategy, especially if you don't need to go anywhere, you know? So, you know, you can kind of maintain your long-term hold period, and we expect kind of overall in the end, you know, a march up in equity once things start to kind of, you know, level out a little bit. So the drawbacks of that are the uncertainty for sure. And then, you know, possible kind of changes to the market in general. And we'll have to watch that together. But, you know, if there are mortgage defaults that start to affect pricing, that could ultimately affect your long-term plans. And then also, there are little kind of details, you know, specific to the market of Bend that we would like to kind of chat with you about. So, for instance, here's an example. If you live in Southeast, Southeast is an emerging market, and there's about to be about 400 homes built over there in the next couple of years. So if you live in Southeast, we might say list now. So just because you want to get ahead of that deluge of inventory and that kind of thing. So I always say, you know, get with us, have a phone call, let's do a strategy session. Even if you're 5-10 years away, it's always useful to, you know, kind of anticipate things, you know, before they come, and just to know you have a plan in place.
Yeah, and this goes back to, you know, the way I believe in real estate. I believe in real estate as a long-term investment. I think if anyone trying to flip or short-term or time the market, I think it's a fool's errand. And, you know, if you're in a home at a good interest rate and you're secure and you don't need to sell, I think it's a great time to hold, because, you know, the time cures a lot of things, including hopefully COVID, but especially the real estate market. So this is, you know, if you're unsure, I think this is a great time to sit on the sidelines. That's not to say that we can't be successful right now, but I'm definitely not against, for someone who doesn't need to sell, to just sit on the sidelines and watch how this plays out a little bit, especially with the snapback that we have as projections, both in the housing and the overall economy.
Yeah. Okay. So here's kind of the meat of it. We wanted to get to 3 questions that I'm constantly asked, and we just wanted to answer them candidly for you all. So the first one is, if my home's already listed, should I be worried about the days on market? And so my answer to this is kind of, you know, there's a myriad of negative effects that go along with days on market that typically we're always trying to hedge against. You know, we're always trying to kind of keep that brown banana effect from happening. And I just don't think it's as big of a deal right now. And to be totally honest and candid with you all, I think people are going to be understanding. They recognize that it's not going to have as much visibility nor traffic. And I think people think the market's probably slower than we're experiencing. And so I think they're just going to not take that into account and not discount a home because of it necessarily. So it's not something that I think my sellers need to worry about. And it's not a reason to shift from scenario 1 to scenario 2, I don't believe. And that's not what I'm experiencing. The second one is, if I list my home now, will people think I'm desperate and they're going to lowball me and it's going to be terrible? And we do have a poll that we're putting on for this specifically that we'd like to hear back from you. But my answer, I'm just going to be truly honest, that could happen, absolutely. And we do our best to hedge against that. Brian mentioned that we're 97, 98% list to sale price, which means we try to keep within 3% of the listing price through our negotiation efforts. And we do everything we can to make sure we're maximizing the absolute price for our sellers. And I would just remind our sellers that they always have 3 options: accept, reject, or counter. And so that's what that's there for. And you have a lot more power than you think you do. And if someone does lowball you, you know, that's a test or a check of your motivation. The other thing I would say to that is that I think everyone is perceiving that a buyer out there is just looking for a deal. And I think they're underestimating the motivation level that our buyers out there right now may have. Not everyone is happy quarantining in their place that they are currently quarantining. There could be, it's the house is too small, there's not enough yard, I'm tired of my spouse, whatever it is, we're seeing a lot of it. And I think, you know, people are more motivated than our sellers might realize. And I think there's opportunity there. So I would say I wouldn't worry about that too much, because it's something we can control in our response. And and you know, there's still buyers out there, absolutely. And then the other thing that I get asked a lot, and I think this is relevant, and I'm going to pull Clint in for this one because it's really outside of kind of my purview specifically, but if I'm challenged financially, should I sell or should I go with a forbearance? And I would just say, first of all, speak to your loan servicer, talk to your CPA, make sure you do your homework first, because those forbearances aren't always maybe what they seem like they will be. So maybe Clint, do you want to give us some insight on that?
Yeah, sure. You know, so as part of the CARES Act, the government has basically given the freedom of homeowners to do what's called a payment forbearance, and that's basically putting, pushing pause on making their monthly payments on their loans, and for good reason. You know, there's a lot of people who are struggling out there financially, and a lot of people who have lost their jobs, and you know, this forbearance is going to be this forbearance option is going to be, you know, a lifesaver for a lot of folks. But you know, across the board, I think, you know, really good advice is if you can make your payment, please do. You know, there are folks out there that are taking advantage of it that don't necessarily have to, and then that does stress the systems a little bit. You know, the forbearance is not a forgiveness. You will have to pay that interest back. And part of the rush to get the forbearance going, they really didn't outline a lot of the specifics for it. And so different loan servicers are taking a different approach on how they do it. So one servicer may have all the interest that you didn't make along the way due once you start making your payments again, while another servicer may just push pause in your payment, and you resume your normal payments after that. But you know, it is not forgiveness, so that any interest that you are accumulating over time will be required to be paid back at some point. But I think the rule of thumb is if you can make your monthly payment, do, and it'll be a lot better down the road. So.
Okay,
Awesome.
I appreciate that, Clint. So I think we've had a really good kind of look at this from a seller's perspective. And I think this is time to turn the tables a little bit. And let's go over to Alice. Alice, you know, she's a credit buyer representative. She has a lot of experience, represents, you know, dozens and dozens of buyers every year. And I would love to hear from you on how you're looking at this from a buyer's perspective.
Yeah, awesome. Thanks for having me. So kind of what my goal is too is just kind of answer some of the burning questions that you all have, kind of, you know, just in regards to, should we wait to buy? Are we expecting housing prices to go down? And kind of a burning one as well, you know, are people still actually buying houses right now? So in regards to if you should wait to buy and indicators of where housing prices are going here in Bend, I want to first look at, you know, one of the major factors I usually discuss with my clients, which is first and foremost, I think it's important to ask yourself, why do you want to buy a house? If you're in a position where you need to buy because you're outgrowing your home, spending money on rent, or relocating, and assuming you're in healthy condition and not experiencing job loss, I think now can be a really good time to buy if that's what you and your family need. So I would say, you know, taking a look at that's pretty important. And then kind of the plan, you know, myself or the LAD group agent that you work with, we can definitely create a customized strategy that works specifically to your needs, but also taking into consideration the market factors, so we can help you feel comfortable and confident moving forward. And perfect. And one thing that I also want to touch on, because I think it's really important to discuss on the buyer side of things, sometimes our clients focus so much on price, they overlook interest rates, and they don't really realize how big of an impact they can actually make on the total cost of the home. So I did a little bit of a workup here based on, you know, $500,000, which is just above our median household price here in Bend, to make simple for me. So I'm going to use this as our example. So let's kind of take a look at the graph on the left. Assuming that you put 20% down, which will leave you a loan amount of $400,000, you can really see how big of an impact the interest makes on the cost of your home. That red section of the bar there is the interest. If you look at the difference between a 4% and 5% interest rate, you can see that you'll save over $85,000 and just under $250 a month at a 4% interest rate versus the 5%. If you compare this to home prices, we would have to see over a 20% decline in prices to be equivalent to just a 1% difference in interest rates. So I think that's probably one of the biggest factors I talk about, with my clients on a daily basis. And then the workup that I did on the right is just kind of putting this into, okay, if I get low interest rates, what does this look like for me? If I hold out and hope prices go down, what that can look like. So that workup that I did there is just a comparison. If we see a 5% decline in prices, so, taking $25,000 off the purchase price, just kind of seeing what the cost of that would be. We definitely don't have a crystal ball, so we don't know where interest rates are going. We don't know how big of price drops, if any, we're going to see, but I think it's important to put this in context. And essentially, even with a $25,000 savings, you'll still end up paying $46,000 more if interest rates go up by just 1%.
Yeah, I think that's interesting. I think a lot of people focus so much on that initial acquisition cost because that's the cost of the house, right? But when I'm looking at this on a $400,000 loan, you're paying almost $400,000 in interest. So, that reflects, just 55% of your total acquisition cost. That's with the assumption that you see it through the full term of the loan and all that. So it's probably less, or it's obviously less. But it's amazing how big an impact interest rates have. And we'll get to, do you have any projections on kind of where interest rates will go?
Yeah, so first I want to take a look at kind of the history of mortgage rates in the last 50 years before I go into what they're expecting interest rates to do in the next 90 days. So I think it's important to see that in the last 50 years, it's clear that we're seeing near historically low interest rates. If you need to finance the purchase of the home or purchase of your home, I think this should help you kind of make your decisions based on your current needs. I definitely, think interest rates are a factor, but I'm not saying purchase a home, solely based on interest rates, but I do think it is an important factor to consider. And then obviously we would recommend to err on the side of caution when planning your strategy. But one thing that I thought was really interesting in the right there, that little red section that we put in, we wanted to throw in a little headline from this morning, actually, from Inman that shows interest rates dropped today and hit a 30-year low. So that is kind of a historical perspective. And if you go to the next slide, it'll kind of get into the projections there. So this is looking at, forecasted projections for the next 90 days. Now, I don't want to dive too deep into the projections because they are speculative, but I do think it's fair to say that they won't stay this low forever. They're expecting some possible bounce downwards before we see the rebound and the upward trends on that. But ultimately, the goal of showing you what these, projections are doing is I think there's a really nice window for the next couple months where you can essentially take advantage of low interest rates, kind of uncertain time and get yourself a really good deal on a good house at a good price and a good interest rate.
Yeah, that's great.
So looking into where we think, the million-dollar question, where do we think housing prices are going here in Bend? Even though we're in a crisis currently, it does not change the fact that Bend Redmond has been rated the #1 best performing small city by the Millikan Institute in 2020 for the 4th year in a row. We're also on a 5-year streak of #1 for wage growth and job growth. Many companies are choosing to relocate to Central Oregon, which I think has also have a really positive long-term or a positive effect on long-term hearing growth. But I think it's important to really kind of take into context, we are in a crisis and we are, dealing with some really tough times, but I think the overall, market and the trends that we've been seeing, it's possible that we'll see those trends continue. And then this is kind of a hard graph to read, and I apologize about that. I was trying to find a good one, and this is a tough one to find. But this is essentially the population growth here in Bend. You can see starting in about 1990, there was a pretty big upwards tick in population growth. And I think there's no denying that we plan to see an upwards growth pattern. We just don't know how that's going to be affected by this crisis and, how long it's going to take to recover. But one thing that I do think with this pandemic, I imagine more companies will actually realize that their employees can successfully work remotely. And I also feel just a little bit how Aaron has mentioned, that this will, push people to move to an area where they can enjoy lifestyle a little bit more, which I think will further add to the migration to Central Oregon. And then, just tying everything back together with what Brian said, I think there's going to be demand that's going to start, outstripping the projected housing supply and land availability, because we are just so limited on that. And then I did want to move into kind of some tips for everyone and just tie all this together. So I do have a lot of clients asking me right now, are people still buying homes? And surprisingly, we actually had more residential single family home sales this March than we did of March of last year. Last year we had 189 closed, and then this year in 2020 we saw 231, and then another 292 homes that are currently pending. I do know that this is lagging data, but one thing I do want to mention is myself and the other team members, we are still working with buyers on a daily basis, and we have safety protocol in place, as do many other brokers, to make sure things are safe for the homeowners as well as the buyers who are touring the homes. And we also have the ability to do virtual walkthroughs, digital signings, detailed inspections with really good photos for people who don't feel comfortable. But I think it's important for people to know that there is certainly activity right now. And if you are in a position, where you need to buy, we're here to support you on that. And then one thing that I do want to mention that is obviously a little bit of a different conversation than what Aaron has, but I do think that there may be some good negotiation power for buyers right now with a very strategic approach. It's definitely not widespread, and they're kind of the plan here is to figure out who the highly motivated sellers are right now, who really can't stay in their home, for whatever the reason may be. But over the past couple weeks, I've had several clients get really good deals on homes. And, I don't want to give anyone false hope. It's not happening everywhere, but I do think there's some really good opportunities for buyers to negotiate, just kind of with all the fear that's surrounded with this. And then one last thing I want to touch on, I do think it's more important than ever to talk with a lender very early in your process, or if you previously were pre-approved, because there's a lot of changes right now in guidelines and income loss. And I just feel like it's really critical, if you're in the market to buy a house, to sit down and talk with your lender, not in person, maybe over digital coffee or something. But I think it's really important to start that process early. One, to figure out where you're at, but then two, to figure out a plan for that critical path that you need to take to make home buying possible for you, so you can take advantage of the low interest rates while they last. So I do want to loop in Clint. We've got a few kind of lending, perspective pressing questions that we're getting. And so I'm going to, bring Clint back in here. And the first one that I think a lot of my clients, and I know a lot of the other buyers' clients, want answered, are which loan programs are the most challenging right now, and kind of what you're seeing, with the different programs and guidelines and restrictions and all that.
Yeah, well, so yeah, Lynn, there definitely have been some changes here over the last 30 days or so. As this kind of pandemic really took hold in earnest, there's a lot of volatility in the market, and that really threw kind of lenders back and put a lot of pressure on them to make sure that they were covering, making sure the buyers qualify and so forth. So, that's great advice, Alice, regarding the pre-approval ahead of time and so forth. But the loan programs, I think, any kind of alternative lending programs, buyers that were looking at maybe 12 or 24-month bank statement loans, loans that were considered what they call expanded prime, which allow for higher debt ratios or some other challenging parts of the qualifying process. Those have pretty much gone by the wayside. With the problems in the secondary market and so forth, the lenders just can't securitize those and get those sold on the secondary market. And so all those pretty much have gone by the wayside at this point. They may come back. There are some lenders that have probably shuttered completely, but I do expect those to come back at some point. Loans that are over the conforming loan limit of $510,400 are considered jumbo loans. Jumbo financing is being stressed right now. There are a lot of banks that have put the skids on that as well. There are still jumbo opportunities out there, but they're getting priced in a way where they're not that attractive. Basically, they're having the same issues with making sure that those are a sellable product after the loan is closed. There are options to jumbo financing. You can do a combination first and second to get your higher loan amount that you're looking for. But those two categories are probably the most challenged at the moment.
Awesome, thank you. And
Yeah,
then
Clint, I had one other
go ahead.
sorry, I had one other question that popped up online. What are you seeing with construction loans when builders are going in for loans in this market?
Well, as a broker, we do what we call third-party origination, which means, I'm working on behalf of the buyers, working with different lenders and banks out there to secure their financing. The third-party construction lenders have been placing those programs on hold, along with the rehab loans, the Fannie Mae Homestyle and the 203K FHA programs. There are lenders starting to put those on hold and not allow new originations in that. As far as the local banks, I'm not sure. That might be a good something we should look into. But as far as the third-party origination, those lenders there are some lenders that still are doing it, but the lenders are starting to really look at securing their financial position and making sure they're not getting hung out there too long. And I think that those programs will potentially get stressed if this goes on much longer.
Awesome. And then, just because we're running out of time here, I want to wrap this up a little bit quick. You did touch on jumbo loans, which was really helpful, and maybe we can kind of wrap the next two questions together. But you and I had a really good conversation about all of the tightened guidelines that have been going on, but I thought it was positive to hear you say that things seems like they've stabilized out a little bit. Can you just touch on that?
Yeah, so recently, the Federal Reserve's really done a good job at stabilizing the markets, the mortgage-backed security markets, which, without getting too far off into the weeds there, but with high volatility creates stress in the markets, and the Federal Reserve's hand in the game is really kind of made things even out as far as the mortgage-backed security markets. And with that, the stress is kind of lightened up, and a lot of the loan guidelines that were adjusted and updated have kind of stuck, and we haven't seen too many additional changes over the last couple of weeks. So I anticipate that, if as long as the markets don't get too volatile again, I think we're pretty much made those adjustments to guidelines that we need here to get through this thing.
Awesome. Thank you for that. And then one thing that I think is another good thing to touch on before we wrap this up and move into the Q&A section. At the beginning of this, rates were all over the place. I mean, they were bananas. They seem to be jumping around a couple times a day. So if you can just touch on why you think things were fluctuating so much, and are you seeing things stabilize out, that would be helpful as well.
Yeah, definitely. So we had really low rates going into this, and when the pandemic really started in earnest, the volatility in the market was huge. I mean, we were seeing probably 8 to 10 times the amount of volatility in a day that we would normally see. Really record-breaking volatility, and really, when that kind of volatility happens, it really stresses the market and puts pressure on interest rates, and interest rates went up approximately 0.75% during the height of that volatility. And the Federal Reserve's come in, and they are doing a pretty good job at helping level that out. They're purchasing anywhere from $15 to $30 billion a day in mortgage-backed securities, taking up kind of the inventory that's missing from the normal marketplace, and that's really made things flatten out. And the interest rates have been pretty consistent here for the last 2 weeks approximately. We've had a lot less volatility. One thing to note is they are going to be backing out of the purchase program, and there could be some additional volatility here in the near future when they back out completely and stop, unless they renew it at some point. But
Got it.
you know,
Okay.
they've been doing a good job at keeping things a lot, you know, a lot more steady here over the last couple of weeks for sure.
Awesome. Thanks, Clint. I really appreciate you joining us. And then we're definitely going to move into a Q&A section and just kind of try and answer some of the questions that people have before we wrap things up here. And one thing that I do want to just throw out there before I move on, I definitely think it's important, you know, through all of this, if you do have questions that we're not able to hit since we're kind of running out of time, reach out to the team member that you're working with, and we can definitely get you, you know, the answers that you're looking for. I think now more than ever, it's really important to be strategic and plan versus, you know, kind of flying by the seat of your pants. So just kind of giving everybody a reminder on that. So Brian, do you want me to kind of just go through the questions that we have and you know, we can kind of address them accordingly, or what are your thoughts on that?
Yeah. Let's throw out those questions, and then I'll just kind of wrap it with my parting thoughts.
Yeah. Do you want to do that before we move into questions for those of the people that need to jump off?
Sure, absolutely. So for everyone that took time out of your day to be with us today, we appreciate it. This is a raw format for us. We're going live, and so excuse us if it didn't come out perfectly. But we're definitely grateful to have you interact with us, give us feedback. I was looking at those polls that we had as we were going along, and very interesting results. We'll share those with everybody as well when we send out a copy of this. So thank you for being here with us. My takeaway, obviously, this is, don't go buy a house based on this, interpret the data how you'd like. But a recession is here. I think unequivocally, the economists are catching up to this fact, and when they finally designate it as official recession, we need to admit that it's here. But keep in mind that housing is not directly correlated to that. It's not directly correlated to the overall economy, and the pricing trends in housing are more unknown, especially in the short term, and they're more nuanced. And individual sectors are going to react differently to the challenges that we see this year. Investment properties are going to be very different than primary residences. The primary residences are probably going to be more affected by people with job insecurity and loan qualification issues. And then, secondary and vacation homes may be more affected by the stock market and people's net worth and where they're holding their assets. So you have to be very strategic, and it's not one size fits all on this market. As a synopsis for sellers, the inventory is currently tight, but there's still people buying in this near and midterm of this year. There are successful ways to navigate this market. For buyers, trying to time the market is tricky. Long-term strategy and tools from these low interest rates that we talked about are more important than ever. And hopefully we gave you some understanding of that, and trying to time the exact month of a bottom of the market. And to try to match that, marry that with the perfect inventory of the home you want is very difficult. And hopefully that when you kind of play out your long-term strategy on life and how you want real estate to fit within it, hopefully you can make more clear decisions that aren't based on the interest rates of the day or the headlines of the day. And obviously, the takeaway is all this could change. Prolonged shutdown, worsening of the pandemic could change the rules. We're going to be arming ourselves with the best data available. And for one of the polls I saw, the synopsis was that people would like to have information like this monthly. So what we're going to do is we'll stay on top of this on a monthly basis. As data changes, as trends become more clear, we will be out here banging the drum, trying to tell the market what's happening.
Awesome. That's great. So I'm just going to hit on a couple questions, and then you can fire away, and if it's fitting for someone else to answer, we will do that as well. And then if there's something that we're not sure about, we definitely can follow up with proper information. So the first one that I've got here, someone wants to know, what are economic experts saying or foreseeing as to whether there will be a flood of notice of defaults in the housing markets once the stay-at-home order is lifted? Do you have any insight on that?
I might have to punt to Clint on this one.
Yeah,
I just don't know where notices of default are yet. Obviously, they're still quite low. And I don't know how this CARES Act and this Forbearance Act, how long it's going to go, whether it's 90 days or 180 days or 180 days plus 180. Clint, do you have any insight on that?
Yeah, that is a tough one. You know, you would think that with the forbearance opportunities that people have, if they are exhibiting some, you know, financial strain, that they can take advantage of that and potentially, you know, save themselves from a NOD that way. You know, yeah, you know, what's going to happen 12 months from now, you know, when those forbearance expire and they do have to either catch up with their payments or start again, you know, it's going to probably depend on really how deep the high, you know, the higher back is. You know, if
Yeah.
folks are laid off and they get hired back right away and can pick up, you know, where they left off, that's great. If companies decide that, hey, we you know, did great without all these folks and we don't hire them back, and you know, that strains the unemployment rate further than expected, you know, then potentially, yeah, there'll probably be NODs increase for sure.
Awesome. Okay. And then this next one, I'll just kind of touch on real quick. You know, we had someone ask if the low interest rates with the low interest rates, do we see lower end housing like in the 500K and under range moving, or if people are afraid of overpaying with the economy kind of trending downwards? I think I alluded to that a little bit, you know, during my conversation, but I absolutely am still seeing movement in that market. I feel like buyers who are out and about looking at houses right now are very motivated. They're pre-approved, they're ready to go. And also sellers who are selling in this market are definitely motivated in that price range. It's generally people who are living in their homes. So I think it's definitely still moving. We're definitely seeing a slowdown, but movement's happening.
It's going to be interesting to see how this plays out over the next 1 to 2 months.
Mm-hmm.
And I think I'm with Clint on how deep these job losses are and how long they go. You know what I talked about earlier. I think if we do not get our economy up and running in the next 6 months, you know, that's going to start to affect all price ranges, including median price housing. So it's going to be a little bit wait to see and see how this plays out.
Yeah. Yeah, I agree. And then I had another buyer question, so I'll just touch on this before I move on. Someone else wanted to know if buyers are trending towards new homes or existing homes. I think the answer is both. I think different buyers have different needs, and that's a little bit more specific to each person versus, you know, what we're seeing as a whole. I do think inventory is a big answer to that. You know, this time of year, usually new construction homes are a little bit more thin just because timing of seasonality. But yeah, they're definitely moving towards both. It's really just what is a right fit for them, and they're not picking one or the other.
Yeah, and traditionally, new homes have always sold at about a 10 to 15% premium over resale homes. So it's obviously kind of price point dependent.
Yeah, perfect. And then
there's one, Alice, that I think is really interesting. I'm going to punt it over to Lad, though, and it's specifically Mark Sternfeld. Mark, hey, thanks for being on here today. And to everyone in healthcare specifically, we just thank you so much for all that you're doing right now, and Mark in particular. But we want to take a second to answer this. So what's your assessment of the recent kind of ROI of just rental properties in general, kind of investment properties? Could you speak to that a little bit and what you're kind of expecting to see, Brian?
So, well, if we talk about ROI, obviously it's how are we measuring that? Are we measuring this in cash flow? Are we measuring this with assumptions of future sales? Are we measuring our ROI after taxes where we depreciate the asset? So ROI, let's start with cap rates. So generally, cap rates in residential real estate in Oregon, in Bend, in such an attractive market, have been generally bought down pretty well. Generally, we're seeing that, you know, investors buying single family homes are finding cap rates anywhere from about 3 to 6, 3 to 7%. Traditionally, you can get higher cap rates in other markets, you know, in Salem or Eugene or Idaho or Washington. You can generally chase higher rates. The reason people are willing to accept lower cap rates on their rental here is because they feel that it's also a good asset to hold long term, and they're not as worried about the cash flow. I think that can be a fool's errand. I think that the worst end of this was back in 2005 and 2006. People were buying things with negative cash flow, negative ROI based on the future value. And I think that's a fool's errand. The way I feel about real estate is that it's got to make sense day one, and it'll make sense in the future. So as far as cap rates, we're seeing about a 3 to 7%. But I do think the investors that are going to be challenged in this market, especially this year, is the ones that were basing their income on short-term rental. So, I just read an update today. Oregon and Bend has a recommendation that short-term rentals are not used, but it's not a mandate. That the proposal that they proposed was shot down by city council, so people still can rent. And they obviously leave it up to them on what's socially responsible. So it kind of depends by sector, and then it depends on long-term. So I think long-term, I feel very strongly about Bend. When my brother first came and visited here from Montana, he's like, I want to buy stock in Bend. We've got all the pieces in place. We've got an amazing economic development council, helping create the jobs. We've got a very progressive city. So long-term, you'd be hard pressed. You won't be able to convince me that holding real estate in Bend long term is a bad move and that it's a bad investment. The cap rates could be a little bit challenged, but I also think there's going to be a wave of people that currently cannot buy or don't want to buy in this market that may defer to rentals. So I actually think rental rates will remain unfazed by this downturn.
That's super helpful. Thanks, Brian. There's one other question that I think is really relevant, and you can probably answer two of these at once. So one is in particular speaking to we talked a little bit about how Southeast is going to see some growth and some building, but also how will development in the Northwest, Pine Ridge Tract, and everything that we're seeing, Westgate, all of it, start to change prices as more inventory comes on.
Yeah, so when we talk about the demand and flood of inventory, what we are not is if anyone's been to Boise lately and they drive through Meridian and Eagle and all those areas, they're great areas, but they are stamping out subdivisions as fast as they can. They take those 40-acre grids, make roads on all sides, stoplights at every corner, and they're just stamping out low-density neighborhoods as fast as they can. And all the production builders are focusing on markets like that. You're seeing it in Washington, you're seeing it in California, you're seeing it in Colorado. And that's where you really see a flood of inventory. And I think we're a little bit sensitive to growth here. We are sensitive because we don't want Bend to change. Nobody does. But when we look at the amount of inventory, it doesn't scare me from a flood of supply side. When I look at Westgate, they only have a limited number of very custom home site affecting a very small part of the market. When I look at Northwest Crossing 2, West Bend Land Company, what's the name for it?
Discovery West. Maybe.
Discovery West, excuse me. When I look at Discovery West, they've only got 650 rooftops, and they have a 10 to 12-year plan to put that on. So when I look at, we feel the impact, but when we look at 100,000 person town, that's, what were your projections that it's going to go to 130,000 by 2030? Frankly, I still see the issue being in supply, and it being in undersupply rather than oversupply.
Awesome. And then in tandem with that, do you see construction cost levels, staying, increasing? I know, of course, there's a lot of questions embedded within that one, but.
I actually think we've got a pause button on the increases in construction costs. The builders I'm talking to are saying that their labor costs have not gone down yet. Usually that's something that comes very late in the cycle because subcontractors generally they're booked out 3, 6, 9 months in advance. But when those contracts start coming due and they're a little more hungry for work, they're expecting those prices to come down, but they don't think material prices are going to come down quite as much because generally with building, when the demand goes down, the supply also goes down. And especially with the disruptions that we've had to the supply chain and construction materials, I think it's going to be more on the labor side, less on the material side, but I don't think housing construction prices will be climbing in the next year.
And I think we've got a couple other questions, but we can just kind of answer those as time goes on. I think that's probably a wrap, and I know we're coming up on, over an hour now. So maybe if we want to thank everyone and sign off, we just really appreciate everyone being here and having a look.
Yeah, thank you for taking your time. We honor the time commitment with all the people here, especially for an hour. We know your time's valuable, and we encourage you to go back to your families, stay healthy, stay safe, and send us an email. We're happy to help in any way we can.
Yeah, thank you, everyone. And
Absolutely.
also, this will be up on our Facebook page as well. So if you jumped in late or anything like that, you can also log on to our Facebook page and watch it there.
And in true COVID style, my daughter's knocking on the door. So it's time to get back to the family.
That's funny.
Take care.
All right, thanks.
Bye.
All right, bye.